Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to have a look at the latest performance across the globe over the past 1, 3, 6, and 12 months. We'll also have a look at the latest with regards to US confidence, the likelihood of a hike from the Bank of Japan by March, and finally, a range of indicators suggesting that growth is ticking up in South Africa. We're going to start off with global returns. Despite a lot of volatility during the month, global equities were flat in dollars over the past month, and US and Japanese equities weren't a hang of a lot better, up between 0.1 and 0.2%. There were two stories in the equity space over the past month. The first was Europe, up 1.5%, outperforming the US and Japan. But the second was South Africa, up nearly 4% in dollars. And it's been a hang of a strong patch for South African equities over the last year, up 43% in dollars, materially outperforming global equities, which were up 19%, and US equities, which were up 15%. So there were two stories at play over the past 12 months. The first was that it was a rest of world story, i.e. not the US. The US, despite strong performance, underperformed global equities, European equities, Japanese equities. And the second story was the outperformance of South African equities relative to the rest of the globe. And even after that, in our view, South African equities are cheap and we remain overweight South African equities. It's a similar story in fixed income. Not much of a story with regards to global returns over the past 12 months, but South African fixed income returns have been very strong. They'll all be up 5% in dollars over the past month on the back of a very strong and conservative medium-term budget policy statement. And South African fixed income has generated a dollar return of 27% over the past 12 months. So equities have done very well in South Africa. Fixed income has done very well in South Africa too. Fixed income, we think, is now closer to fair value based on yields of between 7 and 10 years. So we've shifted that back to neutral. But as mentioned before, we remain overweight South African equities. The other story over the past 12 months has been gold. And it was another very strong month, up 6% in dollars over the last year, up 60% in dollars. Quite remarkable. And that clearly has been very helpful for parts of the South African equity market and the South African economy. Looking at the US index in a bit more detail, the S&P 500 trades on a 12-month forward P of 23 times. The Bloomberg 500 is a very similar index, a very similar 12-month forward PE. If we look at some of the underlying data, we can see that there is this very strong relationship at the moment between size and forward multiple. If we look at the top 10 counters in the Bloomberg 500, the median forward PE there is 29. If you look at the top 50, the median forward PE is 24. If you look at the bottom 50, the median forward PE is 17. There's this very uncomfortable relationship between size and forward PE at the moment. It's in part because the counters that have re-rated the most are now the largest counters, and that in part explains why they are so expensive. But at this point, we're paying a huge amount extra to have exposure to the largest counters. And given how stretched these multiples are relative to normal, it just leads one to be cautious around the largest counters in the S&P 500, and because those are the largest counters in the world, it leads one to be cautious with regards to global equities at this point. Looking at commodities, there's also been a strong 12 months for commodities. If we look at copper as an example, which gives a key indication for where global growth is heading, copper is up 24% over the past 12 months, up 17% over the last 6 months. It gives a firm steer that global growth has been pretty good over the past 12 months and the past 6 months. It's a similar story with iron ore, up 11% over the last 6 months. That wouldn't have happened unless global growth was in a pretty good shape. The one story I would say worth highlighting in commodities at this point, aside from the broad-based strong performance of the past 12 months, has been what's happening to natural gas prices in the US. Up 45% the last month alone. This is a key input for electricity. Should that price remain where it is, we're likely to see some upside to US inflation over the coming year. And there's a range of other indicators suggesting that there's upside risk to US inflation as well. So I suspect that's going to be the key story over the next year, particularly as we head towards midterms. It's this disconnect between rising prices and the low end, which is increasingly under pressure, and wage growth, which is well below inflation. And the impact of that is likely to be quite material with regards to the midterm elections, and we'll provide regular updates on that front. Just broadly with regards to the US, the leading indicator was weak. It's down year on year again. It's been persistently down year on year since 2022. It hasn't given us a firm steer, it must be said, over the past year with regards to economic growth. We've had this pretty interesting disconnect where the leading indicator has been weak, despite the fact that equities are part of the leading index. So equity is very strong, but the leading indicator weak, and the leading indicator weak while GDP growth has been strong. So in some sense, it's actually been a misleading indicator. Nonetheless, it's worth keeping in the back of our minds. There are some indications that the US economy is due a slowdown in the near term. And if you look at consumer confidence recently, that data has been confirming that notion. Consumer confidence from the Conference Board, which is providing a very similar message to the University of Michigan data, is suggesting that consumers are less confident than they were before, and the series has surprised on the downside. And the concerns are related to both economic expectations over the past 12 months and concerns around higher inflation. And both of those are leading consumers to be less confident than they were before, in addition to concerns around current situation for a broad range of consumers. And we're seeing this K-shaped economy story in the US. So the latest high-frequency data suggesting that retail sales at the top end are actually pretty strong, and for the rest, for the middle and the low end, are pretty weak. And that again comes back to that affordability issue, which is likely to be so key over the coming year. Switching to Japan, there in contrast, we're seeing signs that retail sales are accelerating, and in an environment of elevated inflation, that increases the likelihood of a hike from the BOJ. And the market at the moment is pricing in a greater than 50% chance of a hike in December and pricing a hike by March with 100% certainty. And the reason for concern there is that we do know before, when we have seen hikes from the BOJ, it's typically come with a global risk-off response in response to the carry trade coming out of Japan reversing. So it's just something we need to keep a close eye on. The 19th of December is the next BOJ meeting. There is a high likelihood that they hike as soon as that, and if they don't hike by then, there's a likelihood that they will be hiking by March. Switching to South Africa, over the past week, we've had a range of indicators suggesting that the recovery in SA economic growth continues apace. As an example, we had the trade data come out last week. South Africa had another trade surplus, 15 billion rand. It was the 9th monthly consecutive trade surplus. In fact, South Africa has now had a trade surplus for 20 of the past 21 months. The 12-month numbers at 188 billion rand. To put that into context, that's 2% of GDP compared to China's trade surplus, which is sitting at 3% of GDP. So it's been a remarkable performance from South African exporters, assisted by those commodity prices that we mentioned earlier. Looking at the trade data, South African government revenue was up year on year again in October. Our model suggests that government revenue will come in about 50 billion rand above the budget forecast. In the medium-term budget policy statement, Treasury said that it would come out about 19 billion rand above the budget forecast. So we think there is still some upside to government revenue estimates, which would be very helpful for the fiscal position and also very helpful with regards to the outlook from the rating agency. So that's something that we'll wait for, and it should be a bit of good news to come in the February budget. We do need to wait for the December number to have a more precise estimate, but at this point it does look like we're still going to see a pretty sizable upgrade to government revenue. And then finally, on private sector credit extension, it looks like private sector credit extension is starting to accelerate quite meaningfully again, now up 7% year on year. A lot of that's been driven by corporates rather than households, but nonetheless, we're looking at the fastest growth rate for private sector credit extension in 3 years. And we're looking at growth rates that are pretty close to the pre-COVID levels. It's taken a long time to get there, and hopefully this indicates further upside to South African economic growth over the next few months as well. And that's where we're going to leave it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity equity derivatives, currency derivatives, bond derivatives, and interest rate derivatives markets. An authorized financial services provider and a registered credit provider.